Okay, thank you very much, Jan. Thanks for that presentation, John. I will try to build on that as best I can in various ways. I'm pleased to be here at this conference. I congratulate Beverly and Barry for convening us in this way. I think it's an ideal mix of people for drawing lessons from the history of the United States through the Euro, and I'm pleased to be part of it. In my remarks, I rely heavily on the historical work of others, many of them here. I've watched European monetary integration for a long time, but I'm relatively new to a deep reading of U.S. economic history, and I see myself in the role of arbitraging between these two literatures, so to speak, in an effort to try to squeeze the maximum value out of U.S. history for the Euro area. Sometimes I might even push U.S. experience beyond its full value, and we can talk a little bit about what the limits of the historical lesson should be. This is how I'd like to proceed. I plan to address three topics. First of all, a simple comparison of the fiscal regime that applies to the U.S. states and to that which applies to the member states of the Euro area. Second, talk a little bit about the ratification of the U.S. Constitution by the state of New York in 1788. And third, kind of the problem of disciplining states kind of within fiscal unions. I'll plan to devote roughly 3 to 4 minutes on each of these topics. They're not all kind of tightly connected, but they're all relevant to the Euro crisis and represent the next step in my thinking beyond a recent publication that I did on this, which looked more deeply into the Hamiltonian period. Now I'm going to ask for your indulgence a little bit because I'm going to flip through a number of slides. There is a stark contrast between the rules that apply as they apply to the states in the United States and the Euro area. And it's worth pointing out kind of what those differences are. First of all, kind of even if the debt breaks contained in the fiscal compact in Europe are introduced into national constitutions and framework laws, which they are, the process in Europe has been initiated by the center, the process of disciplining the states in this way. And in some cases, it's been initiated by the center under duress. In the United States, rules were adopted autonomously by the states. This has implications for domestic political ownership. Secondly, community institutions play a leading role in enforcing the rules, whereas the U.S. federal government has no such role. It, in fact, can't legislate fiscal rules for the states because this would be unconstitutional. The U.S. model of fiscal rectitude for the states rests on multiple layers of rules. When I discuss this in other presentations, I'm always referring to John Wallace's work. Multiple layers of rules combined with a no-bail norm. European Euro area member states have not been allowed to fail. And the federal fiscal backstop in financial crises, the banking union, which has been essential to protecting the position of U.S. states, the fiscal position of U.S. states, this advances far too slowly in Europe. So as a consequence, kind of the next generation of proposals for a fiscal union, at least some of them, tend to embrace more deeper intrusion into the politics and policies of member states. And these proposals represent a degree of complexity and intrusion that could not possibly work in the United States. I'm dubious that they're going to actually work in Europe as well. Now, the second topic on the New York State and the constitutional settlement, I find this interesting because it addresses this critical transition from the Articles of Confederation to the U.S. Constitution. The central puzzle here is why would New York State, home of the largest port in the 13 states, surrender jurisdiction over tariff revenue to the federal government? right? And this question corresponds broadly, albeit perhaps imperfectly, to why a large AAA-rated country in the euro area, say Germany, might accede to a deeper fiscal union. Well, a couple of simple figures can illustrate New York's position at the time. The state was the fourth largest by population of free persons, and its port was equal to Philadelphia's in tariff revenue, and it was growing more quickly. And kind of tariffs generated more than half of state revenues in the mid-1780s, a greater reliance on trade revenue than on the part of the other states. And New York was the most reluctant of the major states to accede to the Constitution. And its accession was pivotal. Kind of the experience under the Articles of Confederation illustrates why it was reluctant. Under the Articles, the federal government, as we know, was funded by requisitions, and as is also well known, the states generally did not comply. No state delivered its full allotment, and one state delivered nothing at all. So in 1783, Congress proposed that a federal tax be levied on international trade. This had to be approved by the states unanimously. And after much debate, 12 states passed the measure, and the lone holdout was, of course, New York. The Philadelphia Constitutional Convention was called in 1789 kind of to deal with this fiscal impasse. So why was it that New York ratified? It's hard to pin down the definitive explanation, but the records of the New York Ratifying Convention provide some fairly compelling answers. I have just barely looked at these. A lot of people here have looked at them more carefully, I'm sure, and come up with these answers. First of all, the 13 states were in a trade war with Britain, which they were fighting independently, and handing trade taxes to the federal government created a customs union and aggregated their bargaining leverage in that dispute. And this I take from Doug Irwin's contribution to Founding Choices. Secondly, New York citizens held a substantial debt of the federal government, an exclusive jurisdiction over trade revenue secured servicing and redemption. And third, New York, of course, was a principal battleground state in the Revolutionary War. The city had been occupied by British troops during much of it, and could be a battleground in the future, owing to the strategic geography and assets of the state, including hosting the federal capital at the time. So in a sense, New York was lucky that it had fobbed off the capital to Washington, D.C. before the War of 1812, and thereby avoided a repeat of that invasion. So the state had a vital interest in the common defense, which also required funding. So what does this, what lessons does this hold for the euro area? Well, first of all, it suggests to us that the connection between debt and taxes was intimate in the constitutional debate in the United States. The federal claim to tariffs and direct taxes was critically important to Hamilton's plan, including debt assumption. If the historical analogy applies to Europe, community tax must be linked to any debt mutualization of the euro area. Now, the euro area has grappled with the tax question in the form of funding euro area-wide deposit insurance and the financial transactions tax, but the debate about taxes in Europe will have to broaden eventually if this is going to be tackled. Okay? The second lesson is the U.S. experience. The U.S. experience suggests that the authority to issue debt and impose taxes should travel in tandem to the center. A neo-functionalist strategy of incrementalism is therefore risky. These steps require, as we discussed in the banking union session this morning, these steps require a quantum jump. And the third lesson is that in a small but an important way, right? This story about New York is relevant for another reason. And this was brought home to me with a conversation with the director of the European Sovereign Risk Department in one of the three leading credit rating agencies. And it was clear that he was intimately familiar with the case in New York and the transfer of tariff authority to the federal government. And it's safe to say that these agencies, and by extension the capital markets more broadly, will have a laser-like focus on the link between debt and tax authority in the European Union. And finally, the initial conditions are probably vitally important. The overhang of federal debt from the Revolutionary War created constituencies for servicing it effectively. I think today the debt issued by the EFSM and the EFSF is probably not enough. Without an overhang of federal debt, the impetus for fiscal union must come from elsewhere. It's not clear where that's going to come from in the case of Europe, but once the community issues substantial quantities of central debt, if that ever happens in the form of Eurobonds, the political economy of the Euro area will change a la Hamiltonian reasoning. Now, the third issue, and perhaps kind of more complex, is the problem of how federations deal with dysfunctional subfederal units. And as I see it, Europe's response to excessive fiscal deficits on the part of its members have been to double down on the original strategy of the Stability and Growth Pact, tightening the rules and enforcing them more effectively. This strategy kind of assumes rationality on the part of member states, but we know that states are not always unitary actors, and they can be manifestly dysfunctional in political and fiscal terms at times. And if the new set of rules that Europe has introduced fails, that is the six-pack, the two-pack, and the new treaty, Europe could be tempted to correct the political dysfunction by intervening directly in national decision-making on taxes and spending. And how this problem is handled in other federal systems, I think, is particularly relevant. So we can see a foreshadowing of this tendency in the proposal by Jean-Claude Trichet last May. He advocated federal governance by exception when a country that does not apply the recommendations of the Commission and the Council for corrective action, when a country does not abide by these. In such a case, Trichet proposed that the European institutional machinery and the European Parliament in particular should be able to impose, for example, a VAT increase for a country, or an internal devaluation. And democratic legitimacy, which could be problematic, would be underpinned, in his view, by introducing, this is part of a democratically approved treaty change, first of all, and enhancing the democratic character of European institutions. This strikes me, right, as the next logical step along the existing trajectory on which kind of Europe launched itself some time ago. But this and other proposals like it, I submit to you, cannot possibly work. First of all, there is no support for it in U.S. history. Their Reconstruction period, which comes closest, was a fiscal disaster and teaches the opposite. And nor do I find good examples in other fiscal federations, though my survey there is incomplete. I'm aware of and rely heavily on Lars and Mike's comparison with their co-author of the 5 federations. I've also done a little bit of looking at India and welcome other examples, but I'm not expecting to find other examples where this is handled well and provide encouraging precedents for what Europe is going to do. And if we did see some examples, I'm inclined to argue that they're not going to be operative under the political conditions prevailing in Europe. So more generally, I'm deeply uneasy that this approach that European has taken, strong rules enforced by the center, I'm deeply uneasy about this because it risks a repeat of the epic showdown between the Union on the one hand and member states on the other that we saw in 2003, 2004, and I think this could be both very unproductive and quite avoidable. So my favorite alternative is what I call get back to Maastricht, by which I mean Article 125 of the treaty containing the no bailout clause. The U.S. experience teaches that the strengthening of federal institutions protects the Union from contagion when the center denies requests for a bailout from states or countries such as Greece. A robust fiscal role for the center established credibility for the no bailout norm by erecting defenses on the part of the Union from blackmail on the part of fiscally irresponsible states. With the elements of the fiscal union in place, deposit insurance, sharing the cost of bank recapitalization, treasury securities to serve as a safe asset, kind of backed by tax authority, kind of the center can prevent miscreants from collapsing the whole union. Now, if, say, California, and I recognize this is the first time I've given this presentation in California, right? If, say, California were ever to come to the federal government to ask for a bailout, I think this is out of the question for several reasons. First of all, it's the economic fundamentals, because California is a rich state, kind of richer than most of the others. And second, the union has protected itself from contagion arising from the California default. Okay? California bonds being held by rich investors in rich investor portfolios for tax reasons, not within the banking system. So default on these instruments isn't going to create the same kind of contagion that we see to which European states are vulnerable. So owing to this protection that we have in the United States, the other states in the Union are less vulnerable than, say, Germany and Austria are to their peripheries in Europe. So the implication for Europe is that it should put a more robust fiscal union in place in order to restore the protection that many, especially Germans, thought that they had in the no bailout clause of the Maastricht Treaty. This sounds, in a sense, paradoxical. A stronger fiscal union prevents bailouts of unworthy governments. But the usefulness of such protection is illustrated in the debate in the winter of 2010 over dealing with Greece. There were several people, some of them were in the governing council of the ECB, advocated an immediate restructuring of Greek debt. But this option was not feasible because there was no facility in euro area countries at the time, and they couldn't deflect thereby the blowback from a surprise restructuring. Coupling banking union with a fiscal backstop and a rejuvenated no bailout clause is a better way to limit state debt accumulation than balanced budget rules coupled with intrusive fiscal compacts. Now, Charles Whiplosh makes a related argument in a nice paper that he posted back in November. He advocates decentralized fiscal discipline for which the no bailout norm is central. The EMS, the European Stability Mechanism, the ESM, is inconsistent with this, he argues, and should be repealed. And indeed, there is no ESM for the states in the United States that's operated by the federal government. The TARP, of course, was the fund used in the latest crisis, but this was for the banks, not for the states, of course. I argue, and this point is important, that the ESM, I like Charles's argument, but I think the ESM cannot be closed down before the other protective elements of the fiscal union are in place. So as a transitional scheme, while monetary union is incomplete, the ESM is still necessary. But it is true that the ESM is an anomaly, or at least unusual among federal systems. While others bail out their sub-federal units from time to time, I'm not sure there are any that maintain a large standing facility for this purpose, okay? And in the European case, it's permanent. So John was referring to this when he said that the rules were needed for the center against bailouts more than they were needed for the sub-federal units. It reminds me of the Doonesbury comic strip in the early 1970s. One of the characters was convicted of financial fraud, and he exclaims in the cartoon that the pension fund was just sitting there. Right? Well, I can see a European country claiming, well, the European bailout fund was just sitting there, right? And this is the the reason that the euro area has arrived, okay, at this awkward situation is because it has been more of a regional monetary system which sudden stops in payments and balances are a problem than a full economic union in which they're not. We've all cheered the creation of a big bazooka because official financing, a regional monetary fund, has been necessary in that context. But, and this is the critical point, as the euro area kind of makes the transition to a more complete fiscal union, when and if it does, there is a paradigm shift. Kind of the calculus of having a large standing facility kind of lurches from being necessary to being dangerous from the moral hazard point of view. At that point, kind of the institutional solution should be to convert the ESM from a sovereign support facility to a banking union fiscal backstop, kind of separating the sovereign from the banks and reestablish the no bailout clause. This, I think, is the formula for solving the problem of maintaining defenses for the union against blackmail from the periphery without creating fiscal moral hazard for the sub-federal units. Thank you.
Okay.